Hello everyone, welcome back to Money Conversations with Magical. Today I'll be talking about two emotions that are the greatest enemies towards successful investing. And this is greed and fear. Greed and fear can lead to impulsive decisions that can hurt your financial goals. So let's explore and see how to deal with them. Greed and fear are natural human emotions that cloud our decisions, and especially when it comes to matters investment. Greed causes people to take on excessive risks while chasing higher returns, while at the same time not considering the potential losses or the downside of that investment. Fear, on the other side, can lead to people selling cheaply or selling during the low times, while at the same time it can cause some people to fail to invest altogether. So, recognizing these two emotions is the first step towards overcoming them. So, what then are the dangers of greed when it comes to investing? So, greed can cause overconfidence, which causes an investor or someone to take on very risky businesses or assets that are not aligned to his or her risk tolerance or financial goals. So, and this can result to a lot of serious losses. For example, there is an age called the dot-com bubble when people put a lot of money in tech stocks. Tech stocks are stocks that were issued by companies that were dealing in the technology area. So these people put a lot of money in those assets or in those stocks without understanding the fundamentals. And so when the bubble burst, people lost substantial amount of money. So that is what greed can cause. That's just one example of what greed can do in business. I think closer home in Kenya, we've heard of the issues of the DESI, where people rush in to invest in a certain idea because the returns that have been promised are quite juicy, so to speak. So, fear, on the other hand, then causes people to sell when the market is down. So, for instance, you've bought some stocks and the price of that stock is going down, but because of fear that you will lose all your money, you end up selling all your stocks, or you can think of any other business. So, it causes people to sell at a throwaway price. And actually, fear causes some people not to invest altogether. And so what happens is that when you do that, is you miss out on opportunities, or you end up then um, selling or liquidating your investment at the wrong price. For instance, look at what happened for people who were there during the 2008 economic crisis. That was the credit crunch. So some people then who had invested liquidated or accessed or surrendered whatever they had invested in. And so that means that they missed out on the subsequent returns when the market recovered. So that's the two case scenarios of what fear and greed can do to an individual when they're investing. So then the question is, what are the strategies to use to overcome getting uh, a loss or affected by fear and greed? The first thing is that you need to set financial goals. What is your investment objective? Because the moment you understand your investment objective, you will stick to that investment. Understand your investment objective as well as your risk appetite, or what you can call the risk tolerance. The second thing is that you need to develop a long-term strategy. If you've not watched my videos on the principles of investment, I would recommend that you create time and have a look at those videos. So the second way is by having a long-term strategy, because you need to understand that investing is not a marathon. Investing is a marathon. It's not a sprint. It's not like your 100 meters. You have to think long term. You have to have a long term mindset rather than a short term mindset, because in the short term, a lot of things will happen. Markets will change, and then you get the fear. Market things will happen, new ideas will come along the way, and then you'll get greedy and you want to liquidate whatever you have to invest in the new idea that has come. The other thing that you can do, the strategy that you can employ, is diversify your portfolio. When you diversify your portfolio, it means you're spreading the risks, that you're not putting all your eggs in one basket, and that then helps you avoid fear and greed, being led by fear and greed in investment. So when you invest in various assets across maybe geographic regions or across various sectors, then you get to secure yourself better. The other thing you can do is stick to your plan. I've seen people who they take up on any plan because someone else has done it. You've started a certain business, you've started a certain venture, but just because someone else across the road looks like they're doing better in their venture, you stop doing what you're doing and start doing what they're doing. So stick to your plan. So, ladies and gentlemen, by understanding these emotions, implementing the strategies, you can make sound or better money decisions with your investment and be able to achieve your goals. But remember that investing wisely requires that you're patient, that you're disciplined, and that you're thinking long term. Thank you, ladies and gentlemen, for watching this video. I welcome you to subscribe so that you don't miss out on any future insights. I also welcome you to make some comments on any other areas of finance that you'd like us to discuss. Thank you so much.